class, we're going to go over some PowerPoint slides that help us understand the definitions that we're going to use all semester long with regard to accounting. Understanding these definitions is key to what we're going to do. So here we go. First of all, we're going to talk about assets. The term assets is used quite commonly, not only in accounting, but you probably have heard that term outside of accounting. For our purposes, we're going to use a definition that assets are those things that a company owns or controls. So it's not just ownership, but also control of this item that has value, and it has value because it's going to help us create sales. It's going to help us make money. It's going to bring us future economic benefit. And the key term there is future. So make sure that we remember that it's future benefit that we're most concerned about with regard to assets. And so therefore, if it does not bring us, or we are unsure about the future economic benefit, then chances are an item is not an asset. Now, all assets cost money. All assets must be acquired in some way, but that does not necessarily mean that they're an asset because they cost money or that they are acquired, as we'll see here. So some examples of assets that we're going to run into and we might see on a typical financial statement. First of all, cash or money. Cash takes form in checking accounts, savings accounts, certificates of deposit. They're not the most useful asset to a business because they generate very little in terms of additional income. They make you a little interest sometimes, but definitely not the most useful asset, but certainly an asset that has future benefit, that has value, and that we own or control. Buildings and everything that goes along with those buildings is a typical asset, including improvements to those buildings, sidewalks, street lights, all of those things that make a building useful and workable would be considered assets that have value as long as we control the building, own it, and the future benefit is clear that we will be able to use that building to operate our business, to prepare, make our products, house our employees, whichever. Various forms of equipment. Here we have a forklift, but also backhoes or pallet jacks or other things that allow us to move our product around, to allow us to store our product, to display our product. Any of those things that we might utilize are assets. They have value. We own them, or usually own them. Sometimes we control them in the form of a lease, and they are still our asset. And the benefit clearly is going to last into the future. This is an illustration of the stuff. Shelves itself would be an asset, but we're focusing on what's on the shelves. That's our inventory, the stuff we've produced, we've made in order to sell. So that asset is inventory. The future benefit that it's going to bring is it's going to be sold to actually make us money. It has value. We own it because we made it or we bought it from somewhere else. If we are a farmer, we could utilize heavy equipment, machinery like this. Again, the key thing is that it will bring us future benefit to our business. And then sometimes assets aren't as tangible, meaning you can't put your hands-on the asset itself. And so, for instance, the Nike swoosh is a intangible asset that brings Nike future benefit in the terms of everybody being able to recognize it without even having the name. It is used in advertising. It has value. Nike owns it because they have filed a trademark on that particular intangible asset. And so copyrights, trademarks, patents, all of those have value and fit the definition of an asset without actually having a physical presence. So why do companies buy assets? To earn money. They are useful in creating revenues that we'll talk about a little later, being able to produce products that we can sell. It's all about making a profit. So that is our purpose for buying or acquiring, controlling, developing, and making assets, whatever the choice may be. Are they costs? Absolutely. They cost money, but that's not the issue. And it's not how necessarily how much money they cost, but they are costs. But the fact is that they're going to bring us future benefit. So they're going to, we may exchange cash. We may take one asset, cash, and exchange it for a building, a different asset, because it's more useful to our business. Because as we pointed out earlier, cash is not the most useful asset. We may exchange cash for inventory. But in those situations, assets, one asset went down, another asset went up. So all your assets didn't change. Does it matter how it's paid for? Actually, no. Whether or not there's an asset is irrelevant on how it's paid for. For instance, let's say we have this forklift over here. One business goes out and pays cash for that. So they exchange one asset, cash, for a forklift that's more useful for their business. That's the forklift's an asset. Some of us might be concerned though, what if we bought the forklift by borrowing money or by entering into a long-term loan for that forklift, even maybe with the seller of the forklift. Say we go to the forklift dealer and we get a loan to buy the forklift. Does that change that the forklift is an asset? No. We still control that. We still have future benefit. We still have value. So that fits the definition. It doesn't matter that the money came from a liability. So we didn't exchange one asset for another. We simply incurred a liability, borrowed the money in order to buy the asset. So we still have an asset. And so for both companies, the asset, the one that bought it with cash and the one that borrowed the money to buy it, the asset would look the same on their financial statements. So it does not really matter how it is paid for. So what could happen to make it no longer an asset? Well, remember, the idea is it's a future benefit. So anything that may reduce the future benefit of that asset, whether it be just wear and tear over time, or whether it be a natural disaster or a fire or something, could damage its future benefit. And at that point, the amount of the asset could be all the way to zero, or it could just be reduced. So for instance, if there was an accident with this combine and caused it to break down or fall apart or something like that, then clearly the value of that asset has been reduced and its future benefit has been reduced, and that should be reflected in our accounting records, as if same with if the building had been hit by lightning or something of that nature. So that's one of the things we will have to account for, is the change in those assets and their ability to create future benefit based on some form of problem, or just in over time their natural wearing out of that asset. So how does that compare to expenses? Now, the official definition of expenses are reductions in net assets incurred to, there are costs as well incurred to earn revenue. So they cost just like assets do. So in that regard, expenses and assets are the same, meaning they both have a cost, and both of them recorded regardless of how they are paid for. So an expense could be recorded even though you pay for it later, just like an asset could be recorded, as we talked about, with and be paid for later using a loan. Some examples of expenses: utilities, wages, people, the cost of our employees, wages, salaries, whatever you want to call it. Utilities could include gas, electric, water, sewer, any of those things that we need to have our building be, comfortable for our employees or our customers. Rent on a building that we do not own would be an expense. Advertising to tell our customers about our product. Now, we hope that advertising will bring a future benefit, and some people have actually gone so far as to claim that advertising is an asset. But in accounting, we look at advertising and we say, well, the future benefit is uncertain enough. We don't know for sure that anything is going to become of that advertising, and so there we created an expense, and that really illustrates what the difference is between an asset and expense. An asset has that future benefit, and expenses have current or past benefit, or uncertain future benefit. So some things to consider when we're talking about assets and expenses. So why is the cost of this employee an expense rather than an asset? Well, if you think about you being paid, or you as an employee, the benefit of your labor is right now. That is not necessarily in the future, so it's not a future benefit. And you're paid for work you've already done, meaning the benefit is already passed when you get paid, or even when it's recorded, because even if they recorded your labor each day, it would still be after it happened. Nobody pays their employee prior to them doing the work, or very seldom, we should say, because we will have an example. So, for instance, if we look at a professional basketball player, many times they are paid what's called a signing bonus, or an upfront bonus that basically says that they will, if they get paid this money, but they agree to stay with the team for a year, or 2 years, or 3 years. Now, in that regard, that case, actually you're paying for their labor before they perform it. So that cost, or that amount, would be an asset, even though it has to do with an employee in this case. But that's not the norm. That's not usually what most employees experience. But if that were the case, if your employer came to you and said, I'm going to pay you this bonus, but you agree to be here for the next 3 years, see, the future benefit is the next 3 years, and they paid you for it now. So that would be an asset. So there's the kind of the difference. So why is the cost of electricity an expense rather than an asset? All right. Well, electricity, again, is, if you think about when you get your electric bill, it's after it's been used. You don't pay for your electricity before you use it. Most of you would not. And so because the benefit is in the past, that makes an expense. So by the time you get the bill, that electricity has already been used. There is no future benefit to that electricity. In fact, if you don't pay your bill, you're just going to be turned off, and there will be absolutely no future benefit. So it doesn't qualify as an asset. Therefore, as a cost, it's an expense. It has a past benefit, the lights were on, but no future benefit. On the other hand, what happens if our building gets hit by lightning? And we talked about that a little bit earlier. There would be part of that would be, would be reduced in value, most likely, because depending on how serious the lightning strike was, our building became less useful and less valuable and has less future benefit. That loss of future benefit is described as either a loss or it looks like it reduces our assets just like an expense. So in reality, when the usefulness of an asset declines for whatever reason, it becomes an expense. And that makes sense because over time, something that the future benefit of an asset would become in the past. Today becomes yesterday, tomorrow is the idea that anything that right now is maybe in the future, in a month from now, that what was in the future is now in the past. So assets kind of work this way. You purchase and pay for the assets. Now that might happen right at the same time, meaning you purchase it with cash and so you paid for it at the same time. Or it may happen at different times, and you purchase it 1 month and pay for it the next month, or you purchase it today and you pay for it over the next 5 years. That's irrelevant, but those two things happen in one time period, and then you use it in the future. See the arrows pointing to the future. So the use of the asset or the benefit is in the future from the purchase. And we usually want it to be several months at least or years into the future. If it's just like for the next couple of weeks, that's usually not considered enough future benefit to justify considering it an asset. Expenses work this way, that you use or purchase it now, and you may pay for it later. You may pay for it now, it doesn't really matter, but the use and the purchase is either simultaneously or the use happens before the purchase. Like your electricity, in that you use it and then you get the bill, which is really the purchase part, and then you pay for it later in next month or something. So that's the process, and that's the difference. Both assets and expenses involve you exchanging cash at some point, most of the time, either for the asset for future use or in the past paying for something you've already used. And so it's not, the definition cannot be it's just a cost of doing business. That applies to both assets and expenses.